Hi everyone. This video, this lecture is for an accounting standard which at your SBR level is not a very important accounting standard, but it is a part of your syllabus, and knowledge of this accounting standard will help you in other areas like agriculture, even when we do property, plant and equipment, when we do inventory. Knowledge of this standard will help you a lot. The reason why I'm giving this across as a recording is, if you look at the ACCA study hub, and if you look at the guidelines given by ACCA has very clearly told that at the professional level, no new requirements are there that ACCA has from you in terms of the knowledge base of this accounting standard, but it is a part of our syllabus, so naturally we should do it. The name of the accounting standard is IAS 2 inventory. I'm sure this is something that you have been watching and learning and doing since you were in 11th standard. Now, IAS 2 inventory, to get into the depth of this accounting standard, let us first of all understand what all is included in the term inventory. Now, inventory is basically assets that are held for sale in the ordinary course of business, that are assets that are in the process of production for resale, raw materials to be used in production, or in the form of materials or supplies to be consumed in the production process or while rendering services. Let's dive deeper into each of these categories. If I were to talk of assets held for resale in the ordinary course of business, think of a store like DMart. What is DMart? DMart is a supermarket. Now, DMart must be having, what DMart does is it purchases all these consumer goods like chips and chocolates and, wafers and so many things. So, if DMart purchases 100 packets of chips and it has kept them for the purpose of selling to someone else, DMart is not processing it, it is buying it from someone and selling it to the customer. This is held for resale in the ordinary course of business. Assets that are in the process of production for resale. Think of a carpenter. The carpenter has received an order for making a sofa set, and he has cut the wood. He is, polishing the wood, and the production is not complete. The sofa set is not ready. It is in a semi-finished state. This sofa set, which is in a semi-finished state, will ultimately get completed one day and will be sold to the customer. This is also inventory. Now, if you are using some raw material in the process of production, say I am in the business of making mithais, sweets, and I purchase milk and sugar and besan and all of these items which will be used in the production process. This raw material is also inventory. So far what we have seen is raw material is inventory. Something that is a semi-finished good, an item which is work in progress, is also inventory. And assets that are held for resale in the ordinary course of business, finished goods are also inventory. Finished goods that you have acquired and are going to resell, or goods that you have made right from the scratch and goods which are ready. I am a mithai manufacturer. The sugar, milk, besan and all of these things, raw material is my inventory. And when the laddu is ready and packed in boxes, that box is also my box of laddus is my finished product. That is also my inventory. And in the form of materials or supplies to be consumed in the production process or while rendering the services. I mean, I could ask you to think of a photocopy center, for example. What that photocopy center or Xerox center, as we Indians call it, what it does is it prints numerous items and gives it to you. The paper on which the printing is going to happen, that paper is also inventory. It has, sheets and sheets of A4 size papers. These papers are going to be used for printing, that is while rendering services, and hence these are also a part of your inventory. So inventory is assets held for sale in the ordinary course of business, items which are in the process of production, so semi-finished goods or work in progress, raw material to be used in production, and assets that are in the form of materials or supplies to be consumed in the production process or while rendering services. All of these together is your inventory. Now, account IAS 2 has a very basic principle of calculation of valuing inventory at the end of the year. How should inventory be valued? IAS 2 says that inventory should be valued at lower of cost or net realizable value. Now, how to determine each of these is what the accounting standard is all about. But why does the accounting standard say inventory should be valued at lower of cost or net realizable value? Please understand. So let's take a simple example. Okay, I have my opening stock. Okay, I purchase something. From that, I subtract my closing stock and I will get my cost of goods sold. Okay, so let my opening stock be worth 1,000, let my purchases be 15,000, and let my closing stock be 2,500. What is my cost of goods sold? Opening stock plus purchases minus closing stock. Let my sales be 20,000. What is my gross profit? My gross profit is basically sales minus cost of goods sold. Okay, so that is 20,000 minus 13,500, 6,500. Let's see what happens when I change the value of my closing stock. Okay, so please pay attention to how we deal with it. Let my opening stock be 1,000. Let my purchases be again 15,000. But now my closing stock, I have changed the value. The closing stock is 3,500. What is my cost of goods sold? 12,500. My sales are 20,000. What is my gross profit? My gross profit is 7,500. One more, last scenario. Okay. Instead of 2,500, now my closing stock is 1,500. How much is my gross profit? My gross profit is 5,500. So case 1, case 2, and case 3. Okay. Now, please understand, what do you observe by looking at these three cases? Can I say that as the value of closing stock increases, the COGS decreases? As closing stock value increases, the cost of goods sold ka value decreases. And can I also say as the value of closing stock increases, the gross profit increases. The gross profit increases. See, closing stock increased from 2,500 to 3,500. Gross profit changed from 6,500 to 7,500. Now, closing stock has a direct impact on your profit calculation. Why does the accounting standard say that you should value at lower of cost or net realizable value? Please try to understand. Now, inventory valuation directly impacts your gross profit calculation. If I do not value it at a lower level, do you agree that my profit will get overstated? If I say instead of valuing it at lower of cost or net realizable value, if you value it at a higher number, naturally my gross profit will also increase, my asset base will also look bigger, and this is against our prudence principle. What does the prudence principle say? The prudence principle says that do not account for estimated slash anticipated profits, but account for all anticipated or expected losses. When you show the inventory at lower of the two, okay, when you show the inventory at lower of cost or net realizable value, you are understating the asset and you are also understating the profit. So deciding to value inventory at the lower of the two is basically an application of your prudence principle. Okay. So deciding to value inventory at lower of cost or NRV is an application of prudence principle. When you value inventory at lower of the two values, you avoid overstating profits. And when you value inventory at lower of the two values, you avoid overstating assets also. So this is your basic principle for valuation of inventory, that inventory should be valued at lower of cost or net realizable value. Now, how exactly is the cost of inventory determined? The cost of inventory includes the purchase cost, conversion cost, and some other cost. What is purchase cost? The amount that you pay to the supplier to buy 1 unit of that item is known as your purchase cost. If the supplier has offered you a trade discount, naturally that will be deducted while you are calculating the inventory value. Conversion cost is any cost that is spent or which is necessary to bring the asset to its current condition. For example, I am making mithai, I'm making sweets, and I have all these raw material. I have besan, I have sugar, I have milk, I have something else. I'm putting them all together. I'm heating them, performing certain processes that will involve a cost. There will be a person, who will be making laddus and everything. So that person's wages or labor cost will also get added to the cost of this particular item that I am making. So all of these costs are my conversion cost. Okay. So purchase cost is the cost that you pay to the supplier. Conversion costs are costs like direct production cost or wages paid to the worker who is directly involved in the production process. Any supervisor salary, who is the supervisor is supervising the production of the entire factory. So a part of his total salary will get added here. And any other production overheads that you can think of, production overheads like electricity, water, all of these items, those will also get apportioned and absorbed into this particular item. Valuation of inventory or calculating the cost of inventory is a separate discussion, which I will help you with a link for my performance management or costing videos, and there you can understand in detail how is conversion cost and how are all these costs calculated. Point 1, in the SBR exam, you are not expected to calculate the value of inventory because you have done it at the FA level, you have done it at the FR level. At this stage, uh, the expectation is that you have already done all of it, so they are not going to test you on this aspect again. Okay, then purchase cost, we considered conversion cost. If I'm looking at any import duties or if there are any non-refundable taxes, even the non-refundable taxes are included here. I'll help you with a separate video on what exactly are non-refundable taxes. But for now, please understand that if I'm talking about taxes like GST, taxes like VAT, in case of all these taxes, if you know, how do you calculate the final amount payable to the government? It is tax on sale minus tax on purchase. So these taxes have the concept of input tax credit. Hence, these taxes are known as refundable taxes. I will be giving you a separate video for understanding what is the concept of refundable and non-refundable taxes. So refundable taxes like sales tax and VAT and GST are not added, but non-refundable taxes like customs duty are included in the inventory valuation. Basically, then the transportation cost for bringing it from the supplier's premises uh, to your factory, to your godown, is also included in the cost of inventory. Basically, the basic principle is that any cost which is incurred to bring the asset to its current location and working condition will have to be included in inventory cost. So purchase cost that you pay to the supplier, transportation charges from the supplier's location to your warehouse, then when the production process starts, the production overheads, the wages of the workers, all the material cost that is there, all of these together to make that particular final product ready, all those costs are included in the cost of inventory. Then what are other costs? Those costs which are not directly connected with production, but which are necessary to bring the asset to its current location or working condition. Example, you are a manufacturer. Let's talk about juice bottles. Okay, your raw material is fruit. It is necessary to store this raw material under refrigeration in cold storage, because if you don't do this, the fruit will get spoiled. So in this specific case, the refrigeration or the cold storage cost is necessary for the manufacture of final product, which is why it is also included in the cost of final inventory. Which costs should not be included? Costs like selling cost, admin expenses, abnormal wastage, all of these are not connected with production in any way. These should not be included. So a quick recap. Cost of inventory includes purchase cost, conversion cost, other cost, and we have seen examples and explanation for each. This is how the cost of inventory is calculated. What is net realizable value? Net realizable value is basic net realizable value. When will you realize the value? When will you realize the value of that particular item? Only when you sell it to an outsider. Hence, the net realizable value is estimated selling price minus estimated cost to sell. This is how you calculate the net realizable value. Now, a question might come that you know what all is included in the cost of inventory, but how is cost of inventory calculated? There are various methods for calculation of cost. Okay. Methods for calculation of cost. Which are these methods? The first one is specific identification method. You know, this method is used when you are talking about a business which is making customized products for someone. So if I am making customized furniture for you, I'm making it specially for you. There is only one model of that type. So how much wood is used, how much polish is used, how much paint is used, this will be unique to that specific item. So in that case, you use the specific identification method. There is another method known as first in, first out. That is FIFO method. Okay, this method, what is the name? The name of the method is first in, first out method. Material or goods which were, the assumption is goods which were purchased first were sold out first. Okay, goods that came in first went out first. Then you have the weighted average method. Okay, the weighted average method there are two sub methods here. One is the periodic weighted average and the other one is continuous weighted average. In the continuous weighted average method, the average cost is calculated after every purchase. In the periodic weighted average method, the average cost is calculated only once towards the end of the year. There is one more method which is called last in, first out, or the LIFO method, but IFRS does not allow for LIFO method. IFRS only IFRS, IAS, that universe, only these three methods are allowed. Okay. Only these three methods are allowed. LIFO are allowed under IFRS. LIFO method is not allowed. We'll have, again, calculation of cost using FIFO, weighted average, specific identification method is not going to be tested at the SBR level because they have already done it at the FA and the FR level. Still, for your reference, I will be giving you a separate video on how is FIFO, weighted average, and all of these methods, how are these methods used for calculation of cost. Now, a term that you will often come across in your discussion is write down of inventory. Now, what is write down of inventory? Please understand. Siptan purchased 100 units of an item on 29th March for a cost of 120. None of the 100 units was sold by 31st of March. NRV on 31st of March was 128. Inventory is valued at lower of cost or net realizable value. So you will continue to show it at a cost of 120. And on 31st of March, inventory value will be 100 units into 120 per unit. That is 12,000. Now this inventory remained unsold in the financial year 24-25. On 31st of March 25, the net realizable value is 115. Throughout the year, not even a single unit was sold. Total cost of 100 units is 100 into 120, 12,000. But net realizable value is 100 into 115, that is 11,500. So inventory should be shown at the lower of the two, 12,000, and 11,500 ka lower amount is 11,500. Now, when you show it at the lower value in your financial statements, you will have to record an accounting entry so as to incorporate this fall in value. This process is known as write-off of inventory. See, your inventory was at 12,000, you have to bring it down to 11,500. Your closing stock will get credited and your profit and loss account will get debited. P&L account debit to inventory account. There is one more option. What you can do is you can do inventory write-off expense account debit to closing stock account. This is the second way of tackling inventory write-offs. This, of course, will be a very common phenomena whenever you do valuation. Okay, now there is one part, of course, the write down of inventory is something you might not have been aware of, but now you know it. What is the accounting entry? P&L account debit to closing stock, because an asset value is getting eroded, an asset value is getting reduced. Now, after that, there is one point that I would want all of you to focus on, and that relates to valuation of raw material. I can bet that this aspect of raw material valuation, you must have either not seen or you have forgotten about it. Now, what is the rule for valuation of inventory? The rule for valuation is lower of cost or net realizable value. Okay. There is an exception in case of raw material. Please pay attention to what I am saying. Suppose, assume that the cost of raw material is 50 and the net realizable value is 48. This raw material is going to be used in a finished product, and that finished product is expected to be sold at a profit. Okay. It is going to be raw material, of course, will be used in making a finished product, and that finished product is expected to be sold at a profit. Usually, the rule asks you to value any inventory at lower of cost or NRV. In this case of raw material, NRV is 48, cost is 50, so NRV is lower than cost. So going by the usual approach, you would have valued the raw material at 48. But IAS 2 specifically tells you that in case of raw material, do not value at lower of cost or NRV if the finished product in which that raw material is going to be used is expected to be sold at a profit. In that case, value it at cost. To simplify this entire discussion, I will first of all repeat the rule and then I'll explain how to use the flowchart. There is a raw material, different cost, NRV. The basic principle says lower of cost or net realizable value. But IAS2 says that if the raw material is going to be used in a finished product and that finished product is expected to be sold at a profit, then in case of raw material, don't do lower of cost or NRV, keep the raw material at cost. So for raw material, ask yourself a question. Is this finished product expected to be sold at a profit? If the answer is yes. If the finished product is expected to be sold at a profit and the answer is yes, value the raw material at cost. If cost is greater than NRV, still cost. If NRV is greater than cost, always you will end. If the raw material is going to be used in a finished product and the finished product is expected to be sold at a profit, then don't do lower of cost or NRV for raw material, value the raw material at cost. But is this finished product expected to be sold at a profit? If the answer to that is no, then value the raw material at cost or NRV, whichever is lower. This is one part that a lot of people don't know or they don't recollect, which is why I have summarized that in the form of a flowchart. And in case of valuation of inventory, there is one aspect that you should be mindful of, and that is inventory is valued at cost or NRV, whichever is lower, but this working has to be done on a line by line basis, not on an aggregate basis. So there is a Diet Coke, there is Gatorade, and there is Limca. Diet Coke cost 100, NRV 80, Gatorade cost 90, NRV 110, Limca 45 and cost 45, NRV 39. IAS2 expects that you should value inventory on a line by line basis. 100 versus 80, lower is 80. 90 versus 110, lower is 90. 45 versus 39, lower is 39. IAS2 expects you to value inventory on a line by line basis. So on a line by line basis, what is the total? The total is 80 plus 90 plus 39, that is 209. If I do this on an aggregate basis, okay, if I do this on an aggregate basis, what will the value look like? It will look something like this. 235 will be the total of cost, 229 will be the total of inventory. If you do this, you will value the inventory at 229, which is wrong. IAS 2 specifically tells you that do not aggregate. The valuation of inventory has to be done on a line by line basis, not on an aggregate basis. Okay, so compare cost and NRV for each item, finalize the value, and then take the total. Please keep this in mind because this is again a part which everybody knows but nobody wants to remember. And in terms of disclosure requirements, total carrying amount of inventories by category, details of inventories carried at NRV, all of these details would have to be provided in your disclosure requirements in the accounting standard. Now, let's look at a question and understand how inventory valuation is done. Raw materials costing 12,000 bought for processing and assembly for a profitable special order. Since buying these items, the cost price of the raw materials has fallen to 10,000. Okay, cost of raw material is 12,000. NRV is not given. Okay, it's not given. This 10,000 is replacement cost. Why is it replacement cost? Because today, if I were to buy a similar item, I would have to pay 10,000 for buying it. 12,000 is the cost, net realizable value is not given. And this item, raw material, is going to be used in a profitable special order. Okay, the order, the final product in which it is going to be used, that product is expected to be sold at a profit. And IAS 2 specifically tells you that in case of inventory, if the final product in which this raw material is going to be used, if that final product is expected to be sold at a profit, then value the inventory at cost. So you will value the inventory of raw material at 12,000. Okay, look at the second sub question. Equipment constructed for a customer at an agreed price of 18,000. 18,000 is the estimated selling price. This is the agreed amount. This has recently been completed at a cost of 16,800. It has now been discovered that in order to meet certain regulations, conversion with an extra cost of 4200 will be required. The customer has accepted partial responsibility and has agreed to meet half the cost. We are talking about the final product here. Inventory is valued at lower of cost or net realizable value. What is the cost? Cost is 16,800 because it is very clearly given to you. It was completed at a cost of 16,800. It has now been discovered that in order to meet the regulations, conversion with an extra cost of 4200 will be required. The agreed price is 18,000. This is the estimated selling price. And in order to make the item saleable, you have to incur a cost of 4200. So this is estimated cost to sell. But half of that cost will be borne by the customer. Customer has accepted partial responsibility. So your share of the expense is only 50% of that, which is 2100. What is your net realizable value? Estimated selling price minus estimated cost to sell. 18,000 minus 2100, which is 15,900. Cost 16,800. NRV 15,900. Inventory will be valued at lower of the two, and hence the inventory will be valued at 15,900. The entire discussion on inventory at the professional level is of your ACCA exams. Inventory is not going to be tested in the same level of depth. So do not worry too much about this accounting standard, but knowledge of the standard is important. So please watch the entire video, and any questions that you have, do let me know. If there are other notes that you want, please message in the chat box as well, and I'll make sure that the notes are made available to you. Thank you so much. And by the way, I will be giving you two more videos. One video will be about refundable and non-refundable taxes, and one video will be about FIFO, average cost, LIFO, and all of these methods. Not LIFO because it's not acceptable to IFRS. Okay, thank you.